Seeing your portfolio in red or in losses can be very stressful, but it doesn't mean that you have failed. That is a message. Market downturns are a normal part of investing. The key is to stop reacting emotionally to your losses and start managing your portfolio strategically. Whether you are buying as a first-time buyer or you are an experienced investor, these principles apply to everyone. First thing, you need to understand the difference between paper losses and real losses. The drop in your portfolio, it's not a real loss if you haven't sold your shares. It is only a paper loss. You still own the same number of shares. A loss can only become real once you sell. So for people, especially beginners, avoid panic selling during market downturns. And remember that short-term price movement don't always reflect a company true value. If most of you have seen now, like the Nairobi Security Exchange, it's recovering. Most of the counters are going up, so they are recovering. The second thing you need to do, find out why your portfolio is down. Not every decline should be treated the same. If the entire market is falling because of factors which are beyond it, like inflation, changing interest rates, or market uncertainties, political uncertainties, strong companies often recover over time. So patience is important. However, if it's only one company that is declining because of poor financial performance or their fundamentals have deteriorated, whether you had held it for long term, it's high time you evaluate that company and start looking for an exit strategy. But if the business still remains fundamentally strong, just stay invested. The third thing you need to do, review your portfolio allocation. And that's why diversification is one of the best ways to manage your risk. Avoid concentrating all your investment in one sector like the banking sector. Spread your investment across different sectors in Nairobi Security Exchange. Also, complement your shares or your shares investment with other lower risk investment like treasury bonds, infrastructure bonds. This investment can provide stability and regular income when the stock market is under pressure. The fourth thing you need to do, apply the right strategy. Once you have identified the cause of the decline, take action strategically or like a smart investor. If you still believe that the company's long-term potential is still there, consider investing consistently through averaging, or what we call dollar cost averaging, which helps you lower your average purchase price over time. And then review your portfolio regularly and rebalance where necessary. And this one I mean, sell companies that fundamentals have deteriorated or they have permanently weakened, and redirect that capital to stronger businesses with better long-term prospects. Finally, if you receive dividends, consider investing them to buy more shares. This allows your investment to compound over time without adding any new money. In conclusion, markets will rise and fall, but investors who remain patient, diversified, and disciplined are often the ones who build long-lasting wealth like Warren Buffett. And if you're there and you're still struggling in this journey of investing, my number is in my bio. I charge 2K for one-on-one. I'm also selling my ebooks. The link is in the bio. Thank you.